Thank you very much. Thanks to the organizers for inviting me. I've learned a lot in this conference. I'm not a new Keynesian Hank person. I do think a lot about heterogeneity, but I've never done that, so I've learned a ton, and I appreciate being here. This is joint work with Pablo Erasmo. I have to say, we started working on this about 2 months ago, so this is really, really preliminary. The model is not calibrated fully, et cetera. So I would say that when you see results from the model, take it with a grain of salt. We need to do a better calibration. I just want to step back for 1 second. So it was good that the preceding paper was all about heterogeneity across non-financial firms. This is going to be about heterogeneity in financial firms. And we've sort of, in the evolution of heterogeneity, because this is a heterogeneity conference, we kind of started with Bewley, Huggett, and Iagari, where it was household level heterogeneity. That went back a long time ago. Hoppenheim had firm level heterogeneity back to 1992. But then when I started, in 2008, Ben Bernanke said the biggest problem for the U.S. financial system was too big to fail. And so then as a macro person, I kind of said to myself, what macro models do we have to think about too big to fail? And when you start thinking about big, there was no size. In most of the models, if it even had a bank in the DSGE model, there was perfect competition, constant returns to scale. Size is indeterminate. So, even thinking too big, big, there was no size distribution in our models. And so that's what got Pablo and I thinking about introducing a size distribution into the banking industry. So, and then, frankly, in 2018, the Jackson Hole had a whole conference on changing market structures and implications for monetary policy. So Ross Levine and I did a paper there kind of thinking about how does market structure affect bank profitability, and in the presence of deposit insurance, limited liability, there's this moral hazard problem, so that a little bit too much competition, banks can chase yield and become more risky. So there becomes stability-wise, that can be an issue, though market efficiency-wise, it might be good. So there's a potential trade-off between stability and market efficiency. And that's, sort of one of the things that we wanted to explore in this kind of agenda. So that all being said, so this paper is kind of going to start. There's both across time and space in the title, so I have to kind of motivate those two things. In the U.S., let me go through this a little bit because not a lot of people necessarily know that here. There was this thing called the Regal-Neal Act of 1994. Prior to that, banks could not cross state boundaries. And there was actually a little bit of independent state changes before 1994, but it became national that you could go across boundaries. So, and then, as I'll document, the distribution of bank size as time went on has become extremely right-skewed. And so the two questions we kind of want to ask in this paper and in more generally is how does geographic diversification affect bank lending and financial stability across time? And then, we kind of saw in the previous paper, in some sense there was I would say like a little bit of a black box. There was a loan demand, but there wasn't loan supply in the monetary transmission mechanism. There was a perfectly competitive lender that priced assets, but just anything you want, you get at that price. And so this kind of starts to unpack the loan supply side instead of the loan demand side. So they're complementary. So I think it was really good to put the two papers together. Okay, so what am I going to do today? So I'm going to document some facts about the cross-sectional. This is about, whenever I teach my heterogeneous agent class, all I do is start by showing distributions. So here I'm going to start with distributions. And then I'll give you a model. I would say there are going to be some equations. I'll walk you through in words the equations. It might be a little, Tom Sargent said things about being geeky. I can't help it, I'm a little geeky. And then I'm going to do two simple applications. One is to think about regional spillovers, and then the other is to actually kind of start thinking about the bank lending channel. You should have in mind, I think of both the paper before and this paper are applications of corporate finance theory, whether you apply it to non-financial firms or financial firms. That's the connection between the papers. Okay, so here's the first. This is kind of probably the most important figure from the standpoint of the title of the paper. So, so down here is, I was visiting the Minneapolis Fed right before COVID, and I always went to Ellen's class. Ellen taught their students to always point at the horizontal axis and the vertical axis. I'm going to do that. So down on I learned a lot while I was there. So the horizontal axis is just years. Whoops. I didn't learn how to do this though. Wow. Sorry. Okay, maybe I shouldn't even use this. So on the vertical axis is the number of states with active branches. Okay, so what we did here is the top 35 banks sometimes get called the systemically important banks. So we broke up the top 35 banks into two sets. One are going to be the top 4 banks. The other is top 5 to 35. And the top 4 are the blue. The top 5 to 35 are the red. The top 36 to 2% of the banks is yellow. And then the rest of the banks are in purple. And so the first graph is just literally saying, you can see, this is 1994. Oh, Jesus. This is 1994. And I'm just going to point. So here, 1994 is when Regal Neal happened, okay? And what you see is just, as time goes on, you see this would be a perfect application of Tom Holmes has a paper about Walmart and geographic expansion of Walmart. We don't have that. This is a version of that. But you see the big banks, getting up to, the top 4. This is an average across the top 4. They're Chase, Citi, Bank of America, and Wells Fargo. That's the top 4. And you see they're, on average, they're in 40 different states, okay? And then, there's a big difference, and you'll see it when I show you these other graphs, of just how they grew. There is actually a pretty big difference between the top 5 to 35. This is aggregated at the bank holding company level. What we constructed in the bottom graph is again across year, but along this dimension is something that we'll call the diversification index, and it really kind of measures the market share, like how many banks, how many states you're in, as well as how deep you're in those states. So if you have a very small presence in another state, it's going to be a large number. Okay, and the more presence you have in other states, and the more you have going on in each of the states, it becomes a very small number. And again, here you can see that that there's been there's been a huge amount of diversification on the part of these top 4 banks. Okay, this is just a graph of again, it's year. On the vertical axis on the left-hand side are the number of banks, and the red line is just the number of banks. okay? And you see that the number of banks fell from here. We started in 1984. That's the first. We're using call report data. That's the first. That's the best data that we can get that's publicly available. And the best data starts in 1984 from the call report data. So you see that the number of banks has just fallen tremendously. Okay. At the same time, this is on the left-hand axis is the top 4 deposit share. We're going to be. I'm talking about this all in terms of deposit shares, but it's the same with loans and assets. And there's a reason why I'm focusing on deposit shares. The other data is really the good geographic data is at the deposit level. The FDIC has that, and we can use that. What you see is up until so here's 1994. So Regal, kind of during Regal-Neal, the top 4 deposit share was let's say 15%. After Regal-Neal, you see a transition. And then starting in about 2008, you see a leveling off again. Okay, so one of the ways that we're going to think about doing the modeling is think about kind of like a stochastic steady state here and a stochastic steady state there and a transition in between those 2 steady states. The transition comes because regulation changed. So, one way to think about this is we're going to have a ladder model. These are used in I/O a lot. So you kind of invest to get to a higher rung of a ladder. Okay, and that's what's going to be happening along this transition path. Okay, this is that picture. You can't see this well. What we did was we took in real dollars. Basically, we just ranked the top 35 banks in terms of deposits. And this is at the sort of the midpoint of those 2 transition or those 2 stochastic steady states that we were kind of thinking about. This is in 1989. Here's the distribution in terms of the bank size, distribution according to deposits. And then, if it worked well on my website, there's like an animated slide that's kind of like Tom Holmes's stuff. You see this huge branching, kind of the top. These are the top 4 banks I was saying before: Chase, Bank of America, Wells Fargo, and Citibank. So they're just separating tremendously. This is, a lot of firm dynamics models. They focus on, they kind of say the firm, let's say non-financial firms, are very well approximated by power law distribution. The power law distribution is the sort of the dashed yellow line. That's what would be the case for if the bank size distribution followed what's called Zipf's law. And you can see, so on the left-hand side is 1980, plotting the actual deposits in millions of dollars on a log scale. That's on the left-hand side, and you see that the green, in some sense, the biggest banks are down here, and you see that the distribution is below what's predicted by Zipf's law. And then you see, unsurprisingly, you see that the right tail, which is basically what's up there, it's just growing very, very strongly. Okay, so and then one measure that even the antitrust department in the U.S. they use things like Herfindahl indices to understand whether a market is very, very concentrated. And so the one that, since everything we've been talking about, the red is the national Herfindahl, but the blue is really the one you kind of want to think about. And you see, through time, starting in, here's again, Regal-Neal, you see a run-up in Herfindahls at the state level. So, concentration and Herfindahls are not perfect measures of lack of competition or anything, but this is somewhat suggestive. And so this kind of stuff is also going to motivate us to kind of write down a model that has elements of imperfect competition in it. So then, kind of motivated by that, what we did was, this is going to be there's going to be, in some sense, one of the four, in heterogeneous agent models for households, if typical ways we do things, we feed in a stochastic process for income, and we think about what happens in terms of savings and stuff like that. Here we're going to feed in a stochastic process for deposits and think about what happens to bank lending and things like that as a consequence of because the deposits are like a cheap form, because of deposit insurance, a very cheap form of external funding, okay? So what we did was, remember, we're kind of thinking about two stochastic steady states. So prior in 1984 to 93, we estimated, just Ariano Bond AR panel model. And the only thing I don't want you to take, there's only one set of numbers I want to kind of focus on, and they're here. So we, consistent with how we were thinking about the model, prior to Regal-Neal, everybody was in the same state. So that's why we just put all the banks in the same state. I mean, we took the bank. What I mean by in the same state, any bank was restricted to their state. We estimate the deposit process for those banks. And then in this side, we actually allow, it's just to kind of give you an idea, and the mapping between the model and the data, we then go to the latter period, run the same AR panel regressions, and then figure out what's happening to the mean, which you can see, and we normalized all these. But you can see that big banks have a much larger, and these are in logs and stuff, have a much larger mean set funding inflow. But the important thing is to kind of see, in terms of diversification, how the variance of the deposit inflows has dropped a lot. And the other thing is looking at it, the bigger banks have a lot smaller variance of their deposit inflows. Okay, so in the paper that we have, in another paper where we kind of look at capital buffers and capital requirements, that's kind of an important way to get bigger banks. If you look at the data, bigger banks have lower capital buffers than smaller banks on average. But that's just like kind of using Iagari ideas, right? If you have a large amount of variation, you're going to save a lot. And that's how the model can generate that endogenously. So this is one, here's a part of diversification that comes with being big. This is, for the next few ones, because I don't want to run out of time, it just kind of is documenting, here are loan returns that are less variable for big banks. Here are interest margins that are also less variable for big banks. The actual average interest margin is not all that different between the different banks. In the other paper we have markup. You can show markups are actually bigger for bigger banks. And that's something, given that there's been this big revolution of thinking about markups after Eekhout and DeLocker's paper, we're trying to there's some sense in which we're trying to do some of that for the banking industry. This is just charge-off rates. So, when loans fail, they get charged off. Bigger banks have less variability in that. So, all these things are kind of pointing to something like there being a gain to diversification. And then finally, the point I want to bring out in this So these are bank costs. You have to estimate like a translog cost function, et cetera, to kind of get at this. But the point just to take out of this is that average costs are decreasing in size. So that is a suggestion for increasing returns to scale. We're not the first. Loretta Mester and co-authors have found increasing returns to scale as well. But this is just in our data set. We just wanted to think about that. Now, in my mind, Doug Diamond could have won for many different papers. So he has a paper called Delegated Monitoring. In that model, it's efficient because there's basically fixed costs. It's efficient for banks to be delegated monitors on loans. And it's actually a model which suggests that banks should be very big to economize on those costs. And then the delegated monitoring is that you have to get the right bank contract in order to satisfy the incentive problems that banks might have. But anyway, that paper is all about increasing returns and diversification, and we're going to have a sense of that in this paper. Okay, and then the final thing that we're going to kind of have in the model is, so in the black is just detrended GDP. The other graphs, the red graph is just exit rates. But banks can exit for two reasons, one through merger and one through failure. And so what you can see here is that here's 1994. You start to see a big run-up in exit by merger. So as banks, cross state lines, they're starting to buy up other banks. So you get lots of mergers. That's exit by merger. That turns out exit by merger is pro-cyclical, as you might think. And then here's the 2008 crisis. Here's the downturn in GDP. Here's the upturn in bank failures. Okay, so and then when you just get a very simple correlation between GDP and failure, it's counter-cyclical. Okay, so this is the data. So let me just kind of summarize the data. So following Regal-O'Neill, there's a rapid geographic expansion in big banks, deposit base translating to substantial industry concentration and larger Herfindahls at the state level. With geographic expansion came geographic diversifications. Banks branching out nationally enjoy lower variance of deposits, loan returns, interest margins, and charge-off rates than their smaller competitors. There were actually not sizable differences in average interest margins across bank size. That kind of suggests that a good way to model the imperfect competition is Cournot competition. There's evidence for increasing returns, and we saw countercyclical bank exit and procyclical mergers. So there's, in some sense, you could think of the procyclical mergers as banks investing to grow as there's an upturn. I guess one of the reasons I wanted to focus on this to some degree, we're going to have several different stochastic processes for the model, and one of which is aggregate shocks. Okay, so now how do I map? How do we think about mapping the data to the model? So we're going to have in some sense, a delegated monitoring model, like in Diamond. We're going to model the banking industry, the loan market, as being imperfectly competitive. The way we're going to model the growth is think that like kind of Regal-O'Neill basically lowered the cost of geographic expansion. So they're going to just invest in order to grow, and they're going to be able to when you invest and move to different like types. So we'll think of there being state banks, regional banks, and national banks. As you grow, you get that Markov process that I was showing before. So when you go from a small state bank to a regional bank, you start getting a different deposit shock process and things like that, different cost processes et cetera. Okay. Okay. And then we are going to have that banks can issue, whether you want to think of it as a seasoned equity, or that they have non-deposit external funding. It's going to be the case, as in standard corporate finance models. It's kind of a little bit along the lines of what Andres had, that they bear lower costs. Okay, and then banks are going to compete in the loan market, subject to deposit capacity constraints. And then another thing that I think is very important, at least in the United States, is there's been a big rise in the shadow banking sector. So we have the model has that borrowers are going to make a choice between commercial banks and shadow banks. I'm calling them. The paper says non-banks. Think of shadow banks, whatever you want to. Sounds better to say shadow banks. I don't know. And then there's going to be endogenous bank exit and entry, and then that's going to allow us to kind of focus on how both monetary policy and regulatory policies can affect the bank size distribution. Okay, so here's the basics of the model. The economy is segmented into two regions, and what the regions are we're not going to just think of it as, you could segment it into three regions, whatever you want to apply, the methodology. But just to keep it simple, it's going to be two regions. There are going to be a lot of identical entrepreneurs who borrow to operate a risky project. They're going to be the ones that want to make, loan demand, that are going to demand loans. There's going to be a risk neutral representative household. They're going to be supplying deposits and supplying equity to the banks. We're going to have a world where, the exit decisions on the part of borrowers in Andres' paper, that's an endogenous process, and we're going to have a sense of that happening here. There's going to be a sort of a selection problem that we wanted to account for, that we're able to do that this way. There are going to be three different possible types of banks: national, regional, and state. They're going to receive persistent idiosyncratic inflows of deposits, and they're going to compete in these loan markets. They can expand their base by investing at a cost from internal funds or costly seasoned equity. And there's going to be aggregate, regional, and idiosyncratic shocks, and that's going to generate, along with policy, this endogenous size distribution of banks. Okay, I just want to kind of, there's a lot on one slide, but I think it's good to kind of say, what is stochastic in the model? So there's aggregate uncertainty. There's going to be a Markov process that we match to the business cycle, standard business cycle stuff. There's going to be these region-specific shocks. We take them as IID over time, but that's to keep the model simple. They can be correlated across regions. You just don't want perfect correlation, or else they're just an aggregate shock. And then what I was saying about the kind of risk-taking process. So when so in a given state, which a lender or borrower, is going to take an action of how much they want to run the scale of their project. So they take a loan and they decide, how risky a project do I want to invest in? This is to get a risk-return trade-off. It's a very simple way. I just have to say, again, this is kind of from corporate finance guys, Franklin Allen and Douglas Gale. They have a very simple way of doing this, and we're just borrowing that part from them. The only reason, so the different exogenous shocks, these exogenous shocks, I guess I could point to them. These exogenous shocks affect profitability or the likelihood of success, but also this endogenous choice, and that's what gets the success probabilities actually endogenous. This is what I was saying before, that we wanted to introduce both the ability to borrow from banks and from shadow banks, it's just going to follow a very simple discrete choice problem as people do in the IO literature. And then we have these funding shocks. That was the table 1 I showed you before. Okay, so let me be a little bit more specific about the loan demand problem. So depending on what type of borrower you face, there's some, you get a payoff of this top part with some probability P. And then if the project fails with probability 1 minus P, there's a charge-off associated with that. And the risk-return trade-off is just, if I choose something that I'm going to get a higher return, so RK is higher, that gives me a higher return, but it means that the success probability is going to fall. Okay? And the charge-offs that we think about are just going to be IID across borrowers and time. You have to get a demand curve. So one way to get a loan demand curve is to have the borrowers have an outside option. So we just let there be some kind of an outside option. It's unobservable so that you don't have price discrimination along the demand curve. And also to motivate, in some sense, the monitoring costs, both the project success and the scale are going to be private information. So, since no payoff is in the possibilities, everybody would always claim to have failed unless you monitor them. That's in Diamond and Bernanke and Gertler. So, what happens, entrepreneurs are going to decide whether to fund the project, and if so, who to borrow from, and the type of risky project that they're going to take. Okay, so what are banks? Banks are going to be 3 possible types of banks. These state and regional banks only operate in one region. The national banks can operate across both regions. They get depending upon your size or your type, bigger national banks have a higher inflow of these, insured low-cost funds than small banks. They also have less variability in it. That's what's consistent with Table 1. And then a bank can invest to become larger. So depending upon your current type and how much you invest, you have a probability of becoming larger. That's like in quality ladder models. Okay, so here's, I promise I'll talk you through this. Don't worry about the notation. This is just the profits at the end of the period for a bank. So with probability P, the project succeeds, they get paid back the loan return. With probability 1 minus P, the project fails and they lose the charge-off on the project. They have to pay monitoring costs. And then depending upon, so we let banks be able to save, in a sort of a risk-free asset like securities, or we let them borrow. Think of this as like the Fed funds rate. Okay, so if they don't have enough deposits, they can increase, they can get more external funding, but it's going to be at a higher cost. So they don't want to borrow at the Fed funds rate. This is higher than the deposit rate. And then they pay interest on their deposits, and they bear fixed costs associated with this. I didn't show you the fixed costs, but they vary across type as well. There's a simple balance sheet in some sense. Deposits are going to be equal to the loans you make and any securities or Fed funds that you borrow. The big bank gets to sum their loans over both regions. And then there's, what this is going to generate is a cross-sectional distribution of banks. So here's, in just solving for the loan supply problem, as I was saying, Andres' paper is about loan demand. This is about loan supply. So banks are trying to maximize their expected profitability by choosing loans. The thing that's different here than in a model with perfect competition is that all banks are going to have some degree of market power, so it's going to internalize its impact on loan supply. So I thought about this last night. This could be wrong. I mean, the equation's not wrong, but the interpretation might not be. But, all the Hank stuff got me really excited. So here's my attempt. I'm calling this marginal propensity to lend, okay? So this is like the marginal propensity to lend out of deposits, okay? So this is just and this is the sense in which the mapping may not be perfect. But if you take the first order condition with respect to loans, so what are you getting? This is basically the return you get on loans. You're not going to be in if you always have negative returns, right? So these are the returns to making loans. You get, with success, you get the return on it. If there's failure on the project, you lose the charge-off, and you have to pay to monitor. So that's kind of standard. But what's different is the thing in red, okay, and down below in red. So this is kind of taking into account. The important thing here is to think that a bank is internalizing its effect on interest rates. So just as in standard imperfect competition models, if a bank makes more loans, it's going to have an impact and lower the interest rate. So this is a term that's negative, okay? This, so bank size matters. So that's a sense in which in MPL, there's going to be a distribution of these. So when I go back, I'm going to start to plot these things in some sense. And this is just the fact that banks are internalizing that if they increase interest rates too much, there's going to be selection of bad borrowers to their bank, okay? And that's why it comes in negative, okay? If they borrow, so you can think of there being a multiplier. The fact that there's constraints on how much they can get of insured debt. If they want to get more external funding, they have to pay for it. So it's almost like a little shadow cost multiplier. Okay, so I'll talk to anybody who wants to talk about, but I think this is the bank version of MPCs. Okay, and it's type dependent. All right. So banks, given that I have 7 minutes, I'm not going to spend a lot of time on this. All this is saying is that if I want to grow, I can invest. It depends upon what my profits are right now. This is very similar to what Andres had. I can if I don't have enough funds from profits today to match my investment, I'm going to have to issue seasoned equity. And seasoned equity, there's a cost to seasoned equity, so it's harder for small firms or small banks to grow. That's also consistent with the data you'll see. Okay, and then banks pay dividends net of these injections, and banks are trying to maximize the present discounted value of future dividends. There is an exit choice if they're making negative profits and they expect to be making negative profits, just as in kind of Hoppenheim models, they'll exit. Okay, I'll just say, if we have bank exit, we also have to allow bank entry. We have bank entry. The timing, I'm going to banks make their supply loans at the beginning of the period, entrepreneurs, demand loans at the beginning of the period. The intersection of loan demand and supply is going to determine the loan market interest rate, as in any kind of standard model. And then at the end of the period, all these shocks happen, determining profitability of banks, and then the choices that banks make about whether to grow or exit happen. This is geeky. When I said this is the geeky part, this is just a transition function for the cross-sectional distribution. But because this is a conference on heterogeneity. This is the transition function. And the only reason I'm bringing this up is, exit decisions are here, investment decisions are here, and entry is here. So that's generating this endogenous distribution of banks. Okay, I'm not going to go through this. I'll just say we're solving for a Markov perfect equilibrium. So, given that we're using call report data, model period is 1 year. We solve, we solve this model, and I would love to talk to all, Adrian, all you guys that have really interesting ways to solve these models. We're using something that the IO framework kind of uses to solve these models. But there's elements of which that this is very much like a Crucell-Smith method. Okay, and then we're in the process of calibrating the model. We haven't done that perfectly yet. So here are the two experiments in the last 4 minutes, just to give you how an idea of how this model works. So what we're going to do in this first experiment, remember we have these national banks. We have very big banks. And so what we're going to think about is what happens if there's a recession or a bad time in one region. Does that spill over nationally? Okay, and you can kind of think about this in many as whatever you define a region to be. It's up to you. But do you get regional spillovers, even though there's no change in productivity in one region? Does the recession spill over to the other region? So how we do that is we just take an aggregate shock. It's kept constant at its mean. The regional shock in one region is kept high. The regional shock in the other region is high for the initial 5 periods, and then we decrease it to the lowest productivity for 3 periods, and then just let it go according to its stochastic process. So the only thing that we're doing here is having a recession in the east. Okay, and then this is the result. So hopefully I'll get this thing to work. So this is the west region, and the aggregate shock, is just kept constant. But the east region has a downturn, in the shocks for 3 periods, and then we just let it go. And so what do you see? Because it was good shocks. You saw that lending rises, and it rises in both. The shocks are good in both cases, but then you get this downturn, and you see. The important point here is that the downturn's in the east. So you see a decrease in lending in the east, as you would expect. But you also, because of the national bank, and it's got to deal with the fact that it's facing a downturn in the east, it lowers its lending in the west. Okay, so it's, and any time you lower lending, interest rates are going to be rising in both regions, even though there was an idiosyncratic shock in one region. And you see the impact on, here's in some sense the recession in the east is in blue, but you see the recession spilling over to the west in the red. And the recession has an impact on exit rates. These are the smaller banks exiting in the east, not in the west. Okay, that's just what I said here. Okay, so then in my last minute, let me just say something about the bank lending channel. So, I really like this Kashup and Stein paper. Kashup and Stein, what they said was, because big banks have more access to external funds, that when there's an interest rate, the Fed funds rise. This is, again, somewhat, it's a corporate finance version of what Andres was saying. They can get external funding that smaller banks can't. So they have a paper, what do several million observations tell us about the bank lending channel in the AER? And the idea is just, if I can get external funding, I will not be as exposed to this interest rate rise. Okay, I'm going to be less sensitive. And so we just run this experiment of changing the interest rate for a certain number of periods. And this is, since I'm about to be done, this is the result. So I only want to kind of bring up two things. One is, just here, the fact that lending is going down in both cases. That's kind of clear. That's what we think should happen with an increase in Fed funds rates. This is kind of showing that that there's a switch from the banking. This is something we kind of have to think about how when there are changes that like from the monetary policy can generate that there's a movement to a substitution into non-bank lending, right? So borrowers start to move over because there are higher interest rates that banks are charging. They move over to the shadow bank sector. The part about, this I'll just end, I won't even do my conclusion. If you look at the ordering here of loans, the small banks have the biggest impact and relative to the big banks. So that's exactly the Kashup-Stein kind of result. Okay, so I'll just leave it at that. This is the conclusion. So I should go over here.